Let's first look at the methodologies of valuation. So all the books and courses I've studied so far to explain corporate valuation, they all explain it through these approaches. So we have the asset-based approach, we have the income-based approach, and lastly we have the market-based approach, which, this is based on market valuations. The asset-based approach, such as the liquidation approach, this assumes that the company's assets are sold off in the market to determine market value. So, for example, it involves evaluating all of the assets on the books and estimating how much can be obtained for each item in the market. So, for example, if we have cash, if we have 100 cash balance on the book value, well, cash can be recovered fully in the market as well. So maybe cash would be in the market the same, 100. But maybe if we have inventory, they may only be sold at a discount if we have to sell it very quickly. Or maybe if we have, PPE or real estate assets, they might fetch even more than their book value. So this, theory, this method, it does seem very convincing, but actually it's not used very often in actual practice. Why is that? So the main reason this approach is rarely used is because it evaluates the company based solely on its present state. So by focusing on how much the company could sell for in the market right now, it just fails to account for future potential. So this makes it particularly unsuitable for companies like Tesla, which has very high growth prospects. So if we do a valuation on Tesla using this method, it's going to have a very, very low value. But on the other hand, this method is going to be commonly used for companies with no future prospects. So if you have a company that's undergoing restructuring or liquidation, maybe we can use this valuation methodology. In regards to liquidation valuation, we are going to learn it more in our future courses. And next up we have the income-based approach, which is mostly represented by methods like DCF, the discounted cash flow, and also one of the most famous would be the dividend discount model as well. This is a precursor to DCF, and although the dividend discount model, it's not really widely used in practice, although we do see it from time to time, it's still an important valuation methodology in theory, and especially for understanding DCF. Unlike the asset-based approaches, these methods, they forecast future earnings and then they discount them to present value. And this allows really to reflect the future potentials of the company. However, a major drawback is that they are highly sensitive to assumptions as we have made in our three-statement model. But at the same time, it can really capture the future value of a company. So it's very, very widely used, especially for the DCF. And lastly, we do have some market-based approaches that involve methods that utilize multiples as PE ratios or EV to EBITDA ratios. Some people believe that a company's current market cap, some people believe that the company's current market cap is its fair value. Maybe some people, they think that the historical trend of the company's multiples, it's going to continue in the future. So, for example, if there's a company that had a price to earnings multiple of 30 over the past 20 years, Well, we can say that it's highly likely that, going forward as well, it's going to have a P multiple of 30. And that's how we use, historical valuations. So market cap and historical valuations, although they're not used as frequently as trading comps or transaction comps, they are frequently, they can be frequently seen. And of course, we have, trading comps and transaction comps valuation methodologies. Some people call it comparable company analysis. Some people call it comparable transaction analysis, but for simplicity in our courses, we're going to call it trading comps and transaction comps. Lastly, there is a method that combines all of these approaches. It's going to be called SOTP, or the sum of the parts valuation. So this method, we're gonna see it, in our future classes as well. But to simply put, it's very useful for valuing companies like Johnson & Johnson. For example, in this approach, the huge company is broken down into individual segments for valuation. So for example, if we have J&J, Johnson & Johnson, we have the, business division that sells consumer goods. But on the other hand, there's a huge division that focuses on pharmaceuticals. So although it's one company, actually it's two companies combined. So in this case, we're going to do a separate valuation for the pharmaceutical division and the consumer division. For the consumer division, maybe we use the price to earnings multiple. We use maybe, the trading comps is most relevant, but maybe for pharmaceuticals, using DCF might be most, appropriate. So we're going to do valuations for each individual division and then add them up, which is going to result in the entire corporate value of J&J. So SOTP, this is especially useful for companies with large and complex business models. Anyways, there are even more numerous valuation methods, but ultimately the most important thing is how well we can convince others using these methods. So it is crucial to select appropriate valuation methods based on the company's industry, the growth potential, margins, and etc. In our Tool 1 class and even in our technical interview classes, we will deeply study the three most commonly used valuation methodologies, which is DCF, trading comps, and transaction comps. And in our future classes, we will also explore some other valuation ideas in our 301 or 401 courses. So now let's start with the two market-based approaches. Number one, trading comps and transaction comps.